Earnings and more earnings. Let me welcome on board then Rajkiran Rai. He's the MD and CEO at Union Bank of India, and let's address their set. Mr. Rai, good to have you on the show, and it's been a relatively stable quarter as well for you in a very tough environment. The NII growth has been nearly at about 10%, and you've managed to control the stress on your asset quality as well. Tell us in detail about how the quarter went by was and what worked for you.
Performance-wise, this is the first stable quarter we saw because last year the numbers were distorted because of the moratorium and the Supreme Court ruling on classification of NPAs. And again, when it came to the last quarter, the huge recognition of NPA and interest reversal. So it was very difficult for anyone to get a sense of what are the real numbers. I think the first time we have a very stable quarter where the numbers are very realistic and where we can create a base. But when it comes to this quarter, when I say from the business angle, it was a normal quarter, but it was also again a highly disrupted quarter because the first 2 months, the collection efficiency went very low because of the lockdowns across the country in many states and the heightened infections. But then I think by June, things came back to quite normal levels. So I think this is effort which the bank has put in over the last 1.5 years, particularly the post-amalgamations, and the numbers are reflecting now.
Okay. Recoveries in the meantime have managed to outpace your slippages during the quarter gone by, but we've seen a high restructured book as well, as I can see. Are we likely to see a spillover of COVID-related NPA stress onto your books for the next few quarters as well?
Yeah, I can say mostly the recognition of NPA has happened. But we'll see some more restructuring happening in the second quarter in MSM and retail. We have seen close to 4,000 crores of restructuring in the resolution 2.0 in the first quarter. And another 2,000 crores we are expecting the restructuring in the second quarter. But the NPA recognition will moderate now because our guidance was 2.5% of the book as under credit delinquency for the full year. What we saw in the first quarter is about 1.1% of that. It is because the first 2 months we had a very, very difficult, a lot of difficulty in collections because of the lack of movement. So I hope that the remaining 3 quarters, the NPA recognition, NPA will come down, and we will be able to stick to that guidance of 2.5% delinquency.
Mr. Rai, the composition of your book is pretty broad-based. So you're present across the various segments. You have infra, NBFCs, retail, and other corporates as well. What are the kind of delinquencies that you've seen from each of these segments? And what is the kind of credit demand that you're seeing?
Yeah, the demand from agriculture and retail is quite robust. If you see our numbers also, we have grown about 10% in retail and about 12% on agriculture side. So that is robust, and even the stress level has moderated a lot. Because on the retail, it is actually, if you look at our book, almost 65 to 70% of our retail book is mortgage backed. So we don't have much of personal loan portfolios that way. So naturally, and they're more to the retail, like salaried class. So I don't foresee much bigger problem in retail, because even though the restructuring has happened, but then the collections have improved, and I don't foresee a problem, and the demand is very robust. But to add to that, we have grown almost 27% on the vehicle loan portfolio. That itself indicates the kind of demand which is coming up. So on the agriculture side also, it's doing quite well. Even though we saw some NPAs happening in agriculture, it is mainly because of lack of movements and non-renewal of limits. And generally, these accounts will get upgraded, and particularly with a good agriculture season around, with very good monsoon. So we will see that the NPAs which are already recognized under agriculture also will get upgraded over next 3 to 6 months. On the MSME side is where the stress lies. We see heightened stress in MSME. We are taking all steps. So the new emergency line of credit announced, expanding the scope, it's definitely going to help the MSMEs. And the bank also is taking very proactive steps to reduce the stress. So if the third wave doesn't result in lockdowns, and if you are able to handle it properly, then I think in the next 3 to 4 months, even MSME portfolio should come back to normalcy with the kind of restructuring and the additional funding what we are giving. Now I'll come to the corporate book. The corporate actually has behaved pretty well. So we don't see much stress in corporate, but for one big account, which slipped in last quarter, but then I don't foresee much problem in the corporate book, and they're behaving well. But the issue is the credit growth. So today, if I am flat on credit growth, the biggest culprit is corporates, because there is underutilization of limits, and the fresh demand is slowly coming up, but the utilization of limits are quite low. So I think for corporate is a problem on the credit growth side, but not on the stress side.
Updates that you're giving us. But I do want to focus a little bit more on the retail side of things, Mr. Rai. And across the board, a lot of banks have told us that there is stress in that particular segment. Is this to do with the cash flows that your borrowers have? And can you give us some idea as to what the slippages in that category were?
Yeah. See, our retail book is comparatively different from the other retail books which others like financial sector players may have, because we are more towards housing loan and mortgage loan, and to some extent vehicle loans. Our personal loan portfolio, which is basically unsecured, is quite low. So like when it comes to my bank, I don't foresee a big problem, even though we have seen some heightened slippages. It was more because of the cash flow issues, because it is not exactly because of the moment issues, but it is more of cash flow issues. And almost 2 months, we are not able to connect to people. Like our people could not move out and all that. So gradually the upgradations will happen, and mostly we are secured loans. So I don't foresee a problem as Union Bank. But industry, yes, because the unsecured loan portfolio, which is coming under retail, is facing some issues, mainly because of the loss of employment and reduced income of the people. So it may need some amount of restructuring from various financial sector players, so that we give the right kind of moratorium to these people so that they can come back to normalcy. So we will also see some kind of slippages happening on the retail portfolio. But then wherever it is secured, I feel that in next 3 to 6 months, things should come back to normalcy.
Also, if you could give us some guidance in terms of your run rate of slippages and the kind of recoveries that you foresee from here.
Yes, we had given a guidance that the recovery upgradation for the full year can be around 13,000 crores. Out of that, we said 9,000 is from non-NCLT and 4,000 from NCLT. That was the guidance we have given. In the first quarter, our recovery upgradation was 4,300 crores. But most of it came from non-NCLT cases. In NCLT, we have a strong pipeline of more than 5,000 crores, which is either approved by COC or even approved by NCLTs. So out of that, we have factored about 4,000 crores of recovery in the next 9 months. So, and you're looking at the first quarter, we feel that this 13,000 crores of recovery and upgradations are possible, because we have already done 4,300 in the first quarter. So we are seeing good traction, and we saw a lot of slippage in March and June. And now with things getting normal, we will see a lot of upgradation from these NPA accounts, which are already recognized.
Right. Also wanted to understand, before we let you go, you recently raised capital via a QIP. How long will the current capital last, and what are your capital needs going forward?
Yeah, as of now, we are comfortable with the capital. Our total CRAR stands at about 13.3, and the CET1 at 9.7. As you rightly said, we raised QAP of 1,447 crores in the first quarter, and we also raised about Tier 2 bonds of about 2,000 crores in the first quarter and month of July. So I think we don't need capital that way, because we have a provision coverage of almost 81%. So our operating profits are strong enough for absorbing all the provisioning requirements. So we will be raising capital only for the growth capital. But then this year, that way, we may not need capital. But then to meet the regulatory requirement of having a 25% public float, we may raise capital towards the end of the year, looking at the overall situation. So that is possible. But otherwise, I think the capital position of the bank is quite comfortable.